And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is a special guest. His name is Tim Mitrovich, CEO and Chief Investment Officer at 10 Capital Wealth Advisors, who manages around 450 million. And I believe he's one of the fastest growing RIAs on the West Coast, if I'm not mistaken. Tim, I want to thank you very much for being here. Welcome to the show.
Thanks for having me.
So, Tim, can you begin by giving us a little overview? Tell us your story and how you got involved in this business.
Yeah, I'll try to keep this quick and short. You can pick on the part you'd like me to expand upon, but actually started with the summer internship back in college. Some people introduced me to a broker-dealer, a regional broker-dealer, and started doing some analysis for them. Really loved the ability to mix and match, math, which I'd always had a fondness for, but also politics and sociology and psychology was the thing that and still does captivate me about the industry, which is the ability to pull all those disciplines together. During that time in school, I was a Rhodes finalist, and the group that helped me through that said, hey, you need to go get an advanced degree. So I went to University of Washington Law School, practiced mergers and acquisitions and some contract law at a big Seattle firm for a couple years, but found myself in and I use free time with heavy quotations, being a young attorney, helping other attorneys, with their 401ks, answer questions with them, getting pulled into client meetings with clients who had sold their businesses to help them interview managers and speak the language that I had come to learn over the last few years, and really loving that part of my job. And distinctly remembered my grandfather talking about how he loved his job so much he never felt like he worked a day in his life. And like a lot of young kids thought he was full of it, and then had an epiphany at that moment that, hey, this is probably what he's talking about. If I'm willing to do this for free in what little time I don't even have, that's probably the type of thing I should chase. So I came back to that firm, nice group of guys, but pretty set in their ways, committed to kind of that old brokerage mentality. And I picked up so many different things during my time as a lawyer, and looking at all these interesting best practices from this array of advisors that, again, would come in to pitch our legal clients. And I thought, I think there's another way to do this. I obviously had some thoughts of my own. And so about 8 years ago, I broke off with a group of advisors from that firm and created 10 Capital.
Nice, very nice. And before I was going to ask you another question, but I'll get there later. What is your investment strategy? Can you give us an overview about that, please?
Our investment strategy?
Yeah.
Yeah, this will sound like I'm blowing off the question initially, but stick with me. I think number one is to avoid being dogmatic. I think one of the things I saw from so many different firms and still in existence, certainly was the case in my old firm, was they came to define the things that they used, be that a fund, a product, stock picks, as their value proposition, as opposed to really having their value proposition be creating solutions for clients. And that all sounds simple and obvious, but I know you're pretty familiar with the industry and may have seen the same thing where, again, hey, we're this fund company shop, or it's all about our stock picks. When you look at whether it's clients' risk tolerance, income needs, any of the different things that they may have as part of the solutions that need to come, you need to keep an open mind. And so I think we start there, really saying, where can we put our time to best use to help clients with their needs. So to that end, one of the things we don't do, I guess it's easiest to start there, is we don't do individual security selection inside of our firm. Our clients might have individual securities, be it stock or bond or otherwise, via a separately managed account. We tend to use a lot of funds and ETFs, but the whole idea, again, being, we don't have the time to listen to our clients, get to know them, build a great plan, and not only determine an asset allocation, but then individually run all the securities within that. As we'll tell clients all the time, just like all the great players aren't found on one baseball team, not all the great managers are found within one company, and we want to be able to afford ourselves or avail ourselves of them wherever they may be. And so we again focus, I guess to shorten, I'm happy to dig deeper, of course, more on the planning and asset allocation standpoint, and identifying great managers as opposed to trying to be a fund manager. We'll use the line, but again, there's a clear distinction between being a wealth manager and being a fund manager. And we always want to make sure we're trying to be the former and not the latter.
Can you explain that a little, the difference between the two for the audience?
Sure. So, I mean, for us as a wealth manager, and we've been doing a number of seminars lately to this effect, we've had clients come in who've said, I never really knew it was possible in terms of where were the safeguards for my retirement. Maybe they were living well underneath their means. Maybe they were actually living past their means, but no one had really sat down to help them understand the necessary trade-offs that they had to make. What were those core principles and philosophies that they wanted to help guide their financial decision making? I think it's, and I know something we want to touch on later, which is the classic mistakes that clients make. But one of them is not making intentional decisions, right?
Okay.
There's been a couple Nobel Prize won by Americans to this effect here lately. So we start there, then building a great plan. But then even within that, making sure they understand how Social Security, Medicare, maybe other sources of income they are going to play into their whole picture, right? We run into people time and time again that, maybe they did or didn't have a great investment allocation, but they completely bungled how they went after Social Security, right? Or they didn't understand the different aspects of Medicare. So for me, a wealth manager is looking at absolutely an investment portfolio, but really first and foremost, creating a plan that addresses all the different sources of wealth and means that a person's going to have. On the flip side, a fund manager, if we're picking a fund manager who's going to go, try to build a high yield bond portfolio or a corporate bond portfolio or an emerging market equity portfolio, they should be spending all of their time doing that, right? And focus on that specific niche. And when the time comes for the wealth manager to tap them and say, hey, we need your expertise, that's great. But to build all those plans, and then at the same time try to go out stock pick the S&P 500, let alone anything that might be overseas or a little bit more of a niche asset class, just philosophically, and I think stats bear this out, is difficult to impossible to do.
Got it. So you're more client-driven strategies where you focus on the client, find out what's best for them, and then find managers who can fill that void, so to speak. Is that correct?
Yeah. I mean, there's a lot, we've had people like, well, what about national firm X? But kind of my earlier point is, I've yet to find, and we've yet to build a portfolio set that only needs all the solutions that any given fund company may have, whether that's ETF or mutual fund or, again, a separately managed account. They all kind of have their areas of expertise. They might be okay at a number of things, but they're only great at a few themselves. And so, again, whether it's us building great plans, great relationships, great understanding with our clients, and then identifying great managers, we want to only work with who we feel are great managers, and they're usually not all hanging out in the same place. And so
that makes sense.
We've tried to scale in a much more smart way than try to bring everything in-house.
That makes perfect sense. So my next question, Tim, would be, how do you handle risk, and what mistakes do you see people make with respect to risk management?
Yeah, this is a 19-part series. Is that right? That right? I guess in short, it's twofold, depending on whether we're talking advisor or client. From the advisor's perspective, I think they overpromise and underdeliver. I see all sorts of so-called black box strategies. There's a few robo-type strategies I know floating around out there that claim to have, decoded how to, when the market's going to fall, or put in stop losses and all of these things. I'm somebody who starts the premise the only way I can separate myself is through, discipline and hard work. Not that I'm going to be the smartest person in any given room. And so we try to, I think that's risk management number one, is we can be disciplined enough to get our clients from point A to point B. The idea that we're going to outsmart everybody else in the whole planet through some proprietary methodology, I've never heard of anyone that could do that consistently, and we certainly aren't about that. So for us, risk management is helping clients understand how we'll get through the inevitable. If it's a retired client, how are we going to derive safely enough income off that portfolio and or create pockets within the portfolio that can be picked on should we go through a real period of weakness, right? So the sequence of returns risk, if anybody out there listening wants to Google that, is starting to finally get some recognition in the industry. We've been talking to it about our clients for, again, the better part of 7 or 8 years, which is,
Yes.
if the market averages 8 to 10%, that's great. But what most people don't realize is that since 1926, you've never had a calendar year with a S&P return between 8 and 10%. And so we're building all these straight line plans as an industry, but the market does anything but move in a straight line. And so that's risk management number one, is how do we keep you retired and fund your retirement? From the other, standpoint, whether it's for someone who's in more of a growth mode or retirement client, is whether it's that you've got consistent cash flow coming in, or through, again, asset allocation, having true diversification to be able to pick on a part of your portfolio when markets go down. Like, what is the plan? And what are the different levels? And so we've got moves that we want to make it 10, 15, or 20+% within portfolios to, again, rebalance and take advantage of that weakness, that are part of our methodology, not from trying to predict markets, but again, just a disciplined process of understanding that as markets move down, this is what we are going to do. We're not going to let the emotions of the moment dictate things. It's going to be a process built off historical fact. And I think I'll wrap it up with this. One of my favorite points that most clients don't know, and these are approximate figures, but there's usually 4 or 5% pullbacks in a year, only about 10% pullback a year. And really, it's only about 4 or 5 years that you'll get a bear market, right? And so I think one of the risk management things we can do is educate clients that they don't need to fear that every 5% drawdown in the equity market is going to be the next 20. And right. I think that's how most people think, right? They're like, oh, it's going to just keep going, right? This 5 is going to become 10, the 10 is going to become 20, the 20 is going to be that 40% drawdown of a dot-com or 08 era, when statistically that funnel narrows by about 80%, meaning only 20% of 5s ever become 10s, 10s become 20s, et cetera. And so trying to time that or guess which one is going to be, that's not a process. And it's certainly not one that's going to be supported by market history like what we believe ours is. So
Understood.
Hope that makes sense.
Yeah, that definitely makes sense. So basically what you're saying, just to summarize it proper for the audience, is number one, put yourself in line with the longer term trend, which is up. Number two, don't be scared of every 4 or 5, 6, 7, 8, 9, 10% pullback. It's normal and it's healthy. In fact, instead of being scared of it and running, embrace it, if I understand you
Correct.
Properly. And then
I mean, and people tend to be on one side, right? They're either living in fear of it all constantly, or they're completely oblivious, right?
Correct.
We see other clients on the other hand who are just chasing the S&P 500 returns. They're 65 years old. They're trying to play catch up, or they're being, to be frank, kind of greedy. Yeah. And they're not taking into account that, market pullbacks do happen, and they may happen in a way that could derail your retirement plans.
Understood. And then the other side of the question, let me ask you this question. What about actual portfolio management or money management risk? Do you actually like stop losses on positions or with managers, or how do you handle, I guess, limiting the drawdowns, or is it just more of a longer term play where it's okay to have large drawdowns within a longer term uptrend?
Yeah, I think we do. So we don't do stop losses, again, just because we've never been able to effectively answer based off that last point that I made of how few 5s become 10s, 10 become 20. Like, right. Odds are you're going to get stopped out and the market's going to go back up, right, 80% of the time. Not inevitably, like near term go up, right? Right. And so all you're going to do is get triggered and have to buy back in at a higher price. So that's why we don't do the stop loss or really believe in that. Again, I'm sure there are exceptions to that rule, but for the general client, I think that would hold, and we'll let our other managers deploy that as they need. I think our biggest point is we can do it through, we've created a proprietary, not as an extra fee, but just methodology, it's not a product, of generating income safely. And that is, again, a risk mitigator in the sense that how we're planning on funding people's retirement isn't based off total return averages. It's based off that income stream that we can derive. And we do that without insurance products, because it's typically what people are referring to. And then the other thing is through true diversification, finding things that, may have more modest return sets long term, but again, have very low correlations to either the U.S. stock or bond market so that they can be that thing we can pick on in what's become a very highly correlated word. I know that's a big word, but when you have, bonds at all-time highs, i.e. low to all-time low yields, stocks all-time highs, I built out, that's a very weird world.
Yes.
So what are you going to run to protect your clients in that type of world? Those are the questions we try to answer from a risk mitigation standpoint, as opposed to, I think, how a lot of people, not to say you were, but a lot of people think about it, which is more, it's some different cloaked version of market timing, which we don't pretend to be able to do.
Gotcha. No, it makes perfect sense. So next question I'd like to ask you, Tim, is what are some timeless investing or just money advice you have in general that you'd like to share with the audience?
I think the biggest one that we just keep coming back to, I think there's twofold from a planning and then a portfolio standpoint. From a planning standpoint, it's amazing to me how few, and these are smart people. It's not to say they're making bad decisions, but we talk all the time that working with us isn't about survival. It isn't about good. It's about optimization and what's best, right? And the path between where I think most people exist to where we hope to get them to, and I believe do, is about, again, identifying those guiding principles and goals that are your highest priority, and then from there, making very intentional financial decisions. We see all the time people who, they want to pay for all their kids' school. They want to make memories with their kids when they're young. They want to take their wife or husband on a nice trip. And those are all good things. But if your health is deteriorating because you're working yourself to death at the same time, and you really know that you should probably retire, at least shift careers at some point sooner rather than later, those all may not be able to be done simultaneously, right? And so then you tell someone, hey, is making work optional to help improve your health a bigger priority than maybe that trip or that thing? Well, of course it is. Well, okay, you may say that, but
what are you doing about it? Right. What are you doing about it? Exactly.
And they're like, oh, you're right. Or we'll run into people who will say, well, our kids are our most important thing. Okay. And we're talking maybe adult kids here. I just had this as a recent conversation with a couple. Well, they were recently retired, were loving getting to spend more time together as a couple, and had taken up golf as a passion or traveling the world visiting various courses. So we had talked to them like, well, we'd love to leave our kids some money. And I'm like, all right, again, both of those things are good things. And initially they listed leaving some money for their kids as one of their highest priorities. And I said, well, whether that was buying an insurance policy to that effect or stripping down spending, would you do that as opposed to take 2 of your trips a year to play golf? Well, no, we want to take those trips.
Right.
Our kids, we'd love to leave them something, but we're not going to give up our, last years together in terms of doing fun stuff just to leave them more money. Okay, well, then you need to reorient that decision making. So I think that's the biggest thing is helping people move from good to best in their decision making with more intentionality. Well, from a portfolio level, it's a lot of what we've just been talking about. Understanding how markets work. I think when you tell people, hey, average never happens. They're like, what do you mean by that? Like, well, that 8 to 10% return you hope to see on your stock portfolio every year when you open up your statement at the end of the year and do a State of the Union, like you're almost guaranteed to never see it, right? I didn't know that. Well, then why does everyone say 8 to 10%? Well, that's a long-term average, right? Or explaining to them how few drawdowns get deeper. To us, that client communication is key. Because again, much like the intentional decisions you talk about planning, it's going to help them make better decisions around their portfolios. It's, our industry is really good at platitudes. Hey, be a long-term investor. Don't buy into your fear. But we don't or haven't historically done a great job of explaining why, right? And I think part of the reason is the salesman never was trained to actually know the why. He or she was just trained to tell the platitude to get their client into the product.
Right.
Yeah. Where once the clients understand, they're like, and you only have to roll out a few of these facts where people go like, well, what I thought I understood about markets, I didn't. I'm like, don't worry. It's a weird thing. Most people don't. So what do we do about it? And then that they're approaching it with a fresh perspective of saying, okay, teach me how we get from point A to point B safely. And you've earned, again, more of their trust and respect than just citing another cliche that, again, while true, in and of itself isn't sufficient.
No, that's great. So, Tim, I mean, this whole purpose of the show is to help educate and teach everybody about what the smart money has learned over the years. So what are some of those cliches or those, I guess, just misconceptions outside of the fact that you're not going to have an 8 to 10% return every single year in the market? What other few nuggets of wisdom you'd like to share or educate with the audience?
Well, again, I think the biggest one, it really, again, would depend on where that client or person is coming from. But I think one of them is, we'll talk about income as risk mitigation. We'll talk about income as retirement planning. And a lot of people will think, well, income means no return, right? And they're like, well, I don't want to give up some upside. I think helping explain to clients, again, that income is a form of return, and it isn't mutually exclusive from capital appreciation, right? Okay. Really, we work through 3 circles with our clients where we'll show them a total return circle equals income circle plus capital appreciation circle. Yeah. A lot of people don't understand that. They don't understand that dividends, because you guys like you and I are always quoting them in percentage terms, aren't actually connected directly to stock prices in the sense that they go up and down like stock prices. Gotcha. So again, I think that the importance of income is huge, because I, kind of gallows humor, but joke with clients, here we sit at least for now, an all-time high in the stock market, all-time low in the bond market, all-time high amount of boomers looking to retire. And I'll tell a story about that old George Clooney movie, A Perfect Storm, where the weatherman's talking about the 3 fronts moving in, and if they collide, it's perfect storm. Right. That's what I worry about on behalf of at least the people who are most at risk right now, which are those about to retire or entering into retirement, is it may not manifest, but we're sitting at this kind of all-time high, where people have been, maybe they're over now allocated based on the recent run that market, S&P 500. Their fixed income is not getting them the yield they need, and they're moving into retirement unaware of sequence of return risk, being sold a lot of bad products. I think that's the biggest, overcoming that income bias and unpacking that cliche is one of the biggest things we're trying to get through to clients to help them more safely retire.
Oh, that's great. So next question for you, Tim. What are some mistakes? I know you've covered a lot here, but just if you can recap, what are some mistakes that you see investors make with their money?
Outside of those that we've already covered, I think the biggest one is just understanding that they do need a partner. Obviously I'm not talking about mistakes I see our clients make necessarily because they've chosen to work with us. But again, in a day and age of trying to find a low-cost alternative all the time, of seeing ad campaigns telling you to declare your independence on this, that, or whatever, not enough people stop to ask themselves why. And the reality is, it is a very emotional business. Every time we're asking clients to unpack their dreams and goals, they relate to health, they relate to their loved ones, they relate to things from their childhood that are goals of theirs as adults. Very emotive, very emotional things. And the idea then that we're going to act logically all the time about those things stretches the imagination for at least most people, no matter who they are. And I talk all the time. There's a great piece I read some time ago that talked about the same part of your brain that's triggered by mortal danger gets triggered by losing money. There's almost a 95% overlap in that part of your brain. And you should be scared when a shark fin pops up next to you in the water, right? I did a class with some survival training experts for the military. They talked about, of course, you're frightened when you parachute out over enemy territory because you're playing a shot down. But trusting your gut isn't the right thing. You need to trust your training.
Right.
And lastly to that is, and so that's, again, what I guess we hope to do. And for those people who think that is patronizing or paternalistic, we talk all the time. That's why I have colleagues. I find it very hypocritical that so many advisors work in isolation.
Right.
They're telling their clients they need, a partner, but they don't have partners. It's why we don't try to do all the stock and bond picks in-house. We want to have partners.
Right.
We have analytic partners. We definitely walk the talk we have. And lest anyone think that they're good enough or great enough, I point out Tiger Woods has a swing coach. Tom Brady has a throwing coach.
Well, every athlete.
They don't have those coaches.
Yeah, every athlete has a coach,
coaches
right?
are better than them.
Right.
They have them because they understand the value of that third-party perspective.
Yeah, every single athlete in the world has a coach, even performance-based. And the actors, you mentioned Clooney, they all have acting coaches and things of that nature. So, yeah, that's a very good point.
Yeah.
Yeah. That's so, okay, so on to the next question. What is the best advice you've ever given or received?
Best piece of advice I've been given, I think, would be by my grandfather, who said, "Go where you're wanted."
Nice. I like
And
that.
yeah, I don't know that was original to him or not, but I've thought about a lot of times. I think, again, just thinking about intentional. There's the great book by Daniel Kahneman, Thinking Fast and Slow,
Right.
that essentially alluding to all this time. I'm just always striving to have intentional thoughts. And one of the things we intentionally do is, we try to make relationships right that aren't, whether that's the advisor you wish would give you better advice or the client you wish would be more amenable to your advice.
Right.
I think this fun and you really spending the time knowing your story is what I've interpreted this now over time, and letting you find your people, right? I guess the common parlance would be find your tribe, but I really come to believe that. I've always foolishly tried to fit square pegs in round holes and convince people of certain things. And I'll talk to my guys, kind of a corollary to this, that maybe is a version of my advice is, we're in the explaining business, not the convincing business.
Right.
And if you find yourself ever trying to convince something or someone of, you've gone too far, right?
Yes.
They're not buying into it. I think the best piece of advice I've given is to those people who will come and say, well, how did you know it's the right time to start your firm? Or how do you make decisions for your firm? I've kind of come up with a 3-part test, but of course is situation dependent. But number one is always asking myself, is it beneficial? Am I doing this for good reason? 2, have I prepared sufficiently? And number 3, does it scare me a little bit? I think that's the one that when I think back to the firm, I knew I had this vision for a firm I wanted to create that was very relationship centric, very communication centric, sought not to just spit out platitudes, but really help educate and inspire clients to want to work with us as opposed to out of fear. But it should never feel easy. I see so many people like, oh, it was just an open door. It was easy. I knew I should do it. I've never found my best decision. Those are the decisions I made that I screwed up.
Right. me as well, by the way.
I had a little bit of trepidation about it,
right,
which I certainly did when I launched the firm. But the why of why I wanted to do it was so much bigger than the fear.
Yeah.
But it did mean leaning out over my skis. So that's kind of a 3-part test I do when I'm evaluating anything, which is, even a lot of the things we do now in terms of client communications, from our weekly commentary to our weekly social media series, they scared me a little bit, both in the work that it would take in terms of putting myself out there. But I knew we were doing it for good reason. And so even if it didn't feel natural, I knew we needed to lean into it. It's led to great things for the firm and for our clients.
Yeah, I love that. That's a really good piece of advice. And it's so true on so many levels. So I guess, Tim, in closing here, what is the best way for people to get a hold of you or get in touch with you?
I'm on LinkedIn. Yeah, Tim at Tim Mitrovich, MITRO, V's and Victor ICH, or 10 Capital, the number spelled out, capital.com. Can find us. You can find us on Facebook to that end, or Instagram. On Instagram, it's 10 Capital. But if people look, we're not the hedge fund in New York. We're a RIA in Washington State, but with clients all across the country, and always happy to be a resource for people.
Love it. Well, thank you very much for being on the show, Tim. I really appreciate it and enjoyed it.
Thank you for having me.
Thanks.